All right, good morning. Good morning, everyone, and welcome. We get the last few straggling in here, but we do wish to recognize that many of you probably are not staying in Omaha for another day of the beautiful weather that they usually have at this town this time of year, and we'll be catching a plane, so we understand that people will be headed out and leaving during the course of the meeting, but we said we'd start at 10 o'clock, and we're delighted to do so. So welcome to the Markel Brunch. And I've got Richie Witt, my co-CEO, here with me, and Mike Keaton, who's the president of Markel Ventures. Jeremy Noble would normally be in this spot as our CFO. Jeremy unfortunately had some personal issues that he needed to deal with at the last minute, was unable to join us for the trip, but he sends his regards, and I can assure you he would rather be here than where he is, but things need to be done. So let me just welcome you, and we're just so glad you're here. The first order of business that I wanted to do is introduce some of our colleagues that have joined us for this trip. Now, there's a lot of reasons why we come to Omaha and we do this brunch, and one of the reasons is so that the people of Markel and the leaders within Markel can see the example that Berkshire has set and how things are done here, and can carry this message hither and yon, frankly, all across the globe as Markel operates. So there's a different cast of characters that comes every year just to taste and sample the waters of what happens in Omaha this particular weekend. And I'd like to start off by introducing them, and if folks would just stand and cumulatively stand so the cumulative set of Markel folks can be seen and perceived. So this is a semi-alphabetical order, but not completely. Start off with Tyler Brown, who joined me at the beginning of the year to assist in equities and investor relations. Brad Carnahan, Stan. Brad was someone in the days of pandemic and whatnot who was there with me in the office every single day. So he's in investment accounting, but we got to talk every single day and eat a lot of lunches and got to know one another. His intellectual curiosity, the books he reads, the conversations we were able to have. He was the winner of the T-shirt design contest for the Markel annual meeting that we had in person last year, if any of you were there for that. So his skills just continue to develop and flower as a result. And the winner, the prize that he won was a trip to Omaha to experience it. So, yeah. Andrew Crowley, who helps on Markel Ventures. I think one of the things that's interesting about Markel, and this will be true for more than one person, Andrew is a second-generation Markel person. His father was a president of the insurance company, and I think that is a good thing in a number of ways because it is a marker and represents some of the values and some of the ideas and some of the familial sense of what it means to be part of Markel, even if you're not a Markel by blood or marriage. And neither Crowleys or Gaynors or any of the, we don't have anybody blood or marriage here today, but we do have multi-generation Markel people, so it's the adopted family for so many of us. Sue Davies, who runs HR, is here with us today. Bob Mace from Holland is with us. Now, someone who I don't know whether she's in the room right now or not, because she's in and out and sort of is the puppeteer that makes all of this work, is Georgie Angles. And I would ask you to join me in a round of applause for Georgie. If you want to know how things really work, the answer to that 9 times out of 10 is Georgie. And I know Richie and I regularly call out that name to make things happen. So Georgie does the orchestration of the facilities and things right now. And the next name is someone who works with me most closely, with Georgie as well, Cynthia Fetterman, my assistant of a little over a year. She's probably hustling in and out and making things happen. There she is, right there. Been a magic gift in my life over the last year. So Cynthia and I work side by side, and I'm grateful for that. And speaking of someone who I work side by side with quite a bit, and is the CEO of one of our businesses, Parkland Ventures, Susan Gaynor, runs Parkland and has done so for many years. She, and the Matryoshka doll nature of Markel in so many ways, where we take these behaviors and these things, we've learned it from Buffett, and we'll do it at Markel and the insurance company and Markel Ventures. Susan brought her leadership team with her this year from Parkland. I want to introduce those folks. Ross DeBolt, Sean Mantell, Brian Gehring, Julia Grace, Rob Roy, and Chris Peterson. That's the Parkland leadership team. We're so glad you're here, and I think this is the inaugural visit to Omaha for you all to be part of this. Another colleague that works with me on the equity side, Dan Gertner, here, please welcome Dan. Wendy Goldstein from Brahman Leather. So right there, thank you, welcome Wendy, thank you for joining us. Richard Grinnan, our general counsel. One of our directors, Greta Harris, is here making her inaugural trip out to Omaha. Mike Eaton, who I mentioned on my side, president of Markel Ventures. We have another director who's probably was as well known to you all before he became director of Markel, and that's Morgan Housel, the author of The Psychology of Money and our newest director. Jessica Laird with Nafila is with us. Esteban Manzano, who runs our Spanish operations. Shannon Martin on the administrative team. Alex Martin, and Alex also is a second-generation Markel guy. His father was the CFO of Markel at the time of the IPO, shortly before the IPO. His path is similar to my own. Speaking of your father, that his father, Daryl, started out as a CPA in public accounting and didn't learn the lesson as quickly as I did to get out, but he did learn it. And from the audit side of Markel from KPMG, he joined Markel and was Steve Markel's partner for many years, side by side as the CFO. And he gave his one and only begotten son, Alex, to the cause as well. So welcome, Alex. Glad you're here for that. Mike Meehan, the CEO of VSC. And that's the fire security business that's been part of the family for a couple of years now. And again, we're here for multiple reasons. One of the reasons we come, and Mike is a testament to that, is when Mike and I were chatting and just starting to think about whether VSC would join the Markel family. Fortunately, those discussions were taking place roughly at the same time as what the Berkshire meeting would be. And I said, Mike, I know we haven't agreed to a deal or figured this all out or anything, but if you want to understand Markel and what's going on here and get some validation for what we're trying to do, come on out to Omaha and just take it in for a weekend. And I'm pleased to say, I don't know if it's completely accurate, but I'm not going to let that stop me. We might have shaken hands on the plane ride home. So it was pretty quickly thereafter. So thank you all for being hospitable to someone like Mike, because that matters in ways that you might not recognize at first, but we're glad he's here. Mike Parsley is here with operations back in Richmond. Peter Partee, who's joined us recently to assist on the ventures team, is with us. Kelly Plush, who runs our tax operations, which is a worldwide global challenge these days. Maria Rappin from Nafila is with us. Jim Spangler from Communications. Ben Sumter, another CEO who runs Ellicott Dredges. Friedrich Wolf who runs German and continental European stuff. And I will tell one brief story about Friedrich, and I don't know how many years this goes back, but the deal had been negotiated where Friedrich's company was being bought by Markel. He was joining Markel, and I think it had been agreed to, but it had not yet closed. And that was an insurance deal, and Richie was in charge of that sort of process. So I'd never met Friedrich, but I knew the transaction had taken place, but we never met. And at this meeting, Friedrich comes up to me and introduces himself as my newest colleague, and in ways that are very, very near and dear to my heart. Friedrich came to this meeting on his own nickel at that time. So it was prior to having a Markel expense report, and so I said, that is my kind of guy. Mike Jager in accounting from Richmond offices is here with us, and Christopher Case, who heads up our investment accounting operations. So please join me in welcoming the Markel colleagues that are here on this trip. All right, for housekeeping, I believe we have 2 microphones, and we have no presentation, we have no slides. I think a lot of you have been here in previous years, and the nature of this meeting is that we are here to answer your questions and talk about whatever is on your mind and give you any updates on Markel, but that's not a show that we've produced. It is in response to your questions. And so, 1, 2, if you'll line up. If when you do so, you would say who you are, give us your name, let us know if you're a Markel shareholder. You don't have to be, but if you are, that's great. If you want to say how long you've been a Markel shareholder or something like that, that'd be fun. And where you're from. It's just fun to know where people are coming from, and we'll recognize and answer questions. So with that, let me start to let the queue assemble. I'll give one last preamble statement. So we started doing this. First year I came out here was 1991. And it was shortly after I joined Markel. And what I said to Steve Markel at the time, with what we were trying to build, I said, the people who are most likely to understand what we're trying to do are people who already own Berkshire. So rather than try to get them to come to Richmond, let's you and I go to Omaha and just start meeting people. And the relationships that have been formed and that process over the years have just been spectacular. And they've led to many friendships, many deals. It's too long to list how many good things have happened. The very first brunch we did, and in fact, the number of attendees at this brunch actually correlates pretty tightly with the stock price of Markel. So, when we first came out here, I think the stock price was about 8, and we had 6 people. And I think, and Steve Markel sat there and we drank coffee and ate bagels and just sort of chatted. So the 6 people, I think I can remember who they were. One of them I see here in the audience right now, and that was Chuck Ockery. So Chuck Ockery was one of those 6. Steve Farley, Roger Lowenstein, who went on to write the first really definitive biography of Buffett, his cousin Michael Lowenstein, Jonathan Brandt, who many of you may know from Wayne Cunniff, who's in many cases been one of the analysts who asked questions of Buffett during the meeting, and a gentleman named Peter Kamen from Boston, and I remember that name, and I remember for that reason because I've never seen him since. So I don't know what it is. I don't know what it is we said that pissed him off so much at that brunch, but he should have bought some Markel stock at 8, and like Chuck did, and perhaps he would be here. But this is a great meeting, and we're glad you're here, and we just look forward to answering your questions. So the reason I've asked my friend Mark Hughes to ask the first question. I will fully disclose, he is my friend. I went to his son's wedding last weekend. We've been 30-plus year friends. We met in Omaha, so these are the kind of friendships that develop. And I know that I have this habit of sort of kind of looking towards one side of the room or the other. So there was one time where one of my friends was trying to get recognized to ask a question, and I sort of never saw him because he was out of my field of vision. So we got 2 microphones, and I just wanted to make sure we get things in the flow, 1, 2, 1, 2. So with that, and Mark has a special distinction that I will share with you. So he's one of these guys that is so much fun to hang out with, but he's somebody who I cannot keep up with. So one of his traditions is to be up very early and be in that line, to bull rush the door when it opens at the Berkshire meeting. And yesterday I will report to you that he was first in line and the first person there, so right at the seat. So with dedication like that, you get to ask the first question.
Good morning, everybody. Mark Hughes from Maryland, shareholder for 27 years. I technically wasn't first in line, but I was the first through the door. And the person who was first in line, who got it up at 12:51 in line, is in this room today because I ran into him. But he graciously allowed me to bolt past him, given my old age. So, as a longtime shareholder and a shareholder since before Markel Ventures was even formed, it's been amazing to see the growth in that business. And despite intense competition for deals, you continue to find high-quality businesses run by high-quality people at sensible prices. Can you talk a little bit about your 2 most recent acquisitions, Metromont, Buckner, and tell us some things that we can't pick up from their website and from your press releases, just maybe some qualitative things. As Ventures becomes, I think in the first quarter was more than 50% of the revenues of the insurance business, and hopefully, God willing, someday passes the insurance business and revenues. It's very important to all of us. So can you just tell us a little bit about those 2 acquisitions and what you're seeing in those companies?
Sure, we'd be delighted. Thanks for the question. And just to be sure, it is not a race between ventures and investments. It's a relay race. So we're both carrying the baton hard, and we're both running in the same direction. We want both sides of the house to grow. Now, Mark is being modest because there were some little Easter eggs hidden in his statement that, again, you have to know the rest of the story to figure this out. So, in general, when we buy something, I know as analysts we regularly get, can we have more disclosure around Markel Ventures? Can we get more granular? Can we see the company level stuff? And the answer to that is no. And the reason is because you as shareholders should not want us to do that. There is competitive advantage in this data being aggregated so that you don't specifically expose the flanks of a business to their competitors, because the competitors are going to look for data disclosures just as much as analysts would. We do report the numbers, and we do report the numbers of Markel Ventures, and we break it down because the accountants have beaten me into submission on this, into the categories of products and services, but that's as granular as it's going to get. So with that as a backdrop, one time we announced the acquisition of Cottrell. And Cottrell is the company that makes the trailers that you would see haul cars up and down the road. So if you see 8 or 9 cars being hauled on a trailer going up and down the road, the vast majority, and that's as numerical as I will get about it, of those trailers are made by Cottrell. And it's a wonderful business, and it's a great leader. It's been a great business, great deal. So none other than Mark Hughes called me after he saw that deal, and he did do a little web search and trying to figure things out. And he and I knew one another well enough to know that I wouldn't disclose the specific unit numbers on that. But he started the phone call, and he said, "Well, I've been Googling around and kind of did some background research, and best I can tell, I should congratulate you for buying another leading company in an industry that I didn't know existed." That's sort of the category that Cottrell fell into, and really the same can be said of Buckner and Metromont. You know, those are leading companies and things that I didn't even know existed before they happened. And so specifically, the way those two deals came about, and I've said this for the last couple of years, given the pricing in the private equity market, I've started each, was it been 5 years that I've said, I don't think we'll buy anything this year because things are just too expensive. But we've bought something, sometimes more than one thing, each of the last 5 years. I'll say the same thing now. Here it is, May 1, April 30, whatever it is. We got nothing in the hopper, but we do have working phones that people call us, and sometimes people do. So we've got this call related to Buckner, where somebody who we had known, we had worked on a transaction before, didn't make an offer on it, but just some people we knew. And they called and they said, you know, we have this very interesting business that it's the kind of thing you might take a look at. And so we asked for a thumbnail description, and they said, well, they have the largest fleet of the biggest cranes in North America, and they're just in North Carolina. So A, that sounded pretty cool, and B, it wasn't that far. So sure, we'll go see him. And we went down to see him, and we spent a day together, and we sort of swapped stories and looked at the yard and had to keep Mike from touching the cranes because that's what he really wanted to do. And on and on and on and on. And Andrew and I were having drinks and then dinner at the end of the day. And Buckner is a fourth generation family business. And that's the kind of thing that really shows up for us quite strongly. Because when you're selling a business, if the only thing you're looking for is the highest bid, we're not going to be the buyer of that. We can't compete just flat out in auctions where money is the only object. Now, money is an object, and you got to get that reasonably right. But we need people to want to be part of Markel. And so when you have a fourth generation family business, again, almost like Markel, where I would say, you know, the three generations of actual Markels ran the business, but the people who I introduced you to today, we would define ourselves as the fourth generation of Markels, even though we don't have the blood or marriage ties. So we care about things in a different way, in a generational way, rather than just a transactional way. And that mattered to the people at Buckner as well. And the fourth generation is a 30-some-year-old woman. And I know I'm going to get in trouble for telling this story because I know there are decent people in the world of private equity, and I suspect many of them are in this room today. So in Charlie Munger-like fashion, I'm going to start offending people right off the bat. But Meredith Williams, the 30-some who's, you know, in an operating role right now, you know, she grew up obviously around the business and went away to school and then went to the big city. And by the end of the day, we'd had enough drinks in us and enough time together that it was getting a little loose. And Meredith, and I think she was actually looking at Andrew at the time, and she said, you know, when I was in New York, I actually dated some of those private equity guys, and I hated them. So that's why we're talking to you. And I proceeded to get my checkbook out and bought the business. So that is how Buckner came about. And it is the largest fleet of the big heavy-duty cranes in North America. And for instance, so tying it to what you saw yesterday at the Berkshire meeting, that wind farm stuff is a applicable market. So when they show those wind turbines out there, and they're epically large, they don't just hop off the ground and get up there in the air. Something has to lift them. And you can't lift them over the internet. You can't lift them from a foreign country. You must be present to win. And Buckner Cranes, and their vendor is Liebherr, which is a company that Friedrich knew from Germany. Buckner Cranes are the ones that do that, as well as many other things. If you're looking at a big sports stadium getting built or redone, and you have to lift thousands of tons, Buckner has the crane and the fleets and the technical expertise of the crews who know how to operate that sort of thing. So that's the story of Buckner, leading company in an industry that I didn't know existed beforehand. Metromont, similar kind of story. We got an inbound phone call, third generation family business, precast concrete. So among the things that precast concrete is used, the great growth of data and internet traffic. Apparently it is important for archiving and storage to take place of those cat videos that I sent on Facebook a number of years ago. But they're held in data centers all around the world, and we seem to need more and more of them all the time. And precast concrete is a way in which you can build data centers better, faster, cheaper, which is what one has to do in a competitive world these days. Wonderful gentleman who runs it, and this is a deal structure, again, that I speak speaks to the values of Markel and the values that people were looking for. The way that worked is on day one, we bought just a smidge over 50% of the business. And for the next 8 years, we will buy 1/8 of it at the same formula mechanism as we did on day one. And I love that. We'll do any deal in the world under that kind of circumstance, because you really are standing side by side with the seller and management for a meaningful period of time. So you're both rooting for the same thing. And if that business does better than what we would expect over the next couple of years, we're going to pay a little more, which I think is fair to the seller. But win-win. We're happy about that. That's a great outcome. If cyclicality is such that it has a rough year or two, we pay a little less for that tranche. But the seller obviously doesn't want that to happen, and he's doing his best to make sure the business is run well. So by the time we get to 8 years from now, we'll own 100% of it. And we have that kind of time horizon, I mean, that kind of way. And as an advertisement for anybody in the room talking about looking for partners, we love to join forces with people who think that way. You have anything to add on those two deals, Mike?
Everybody hear this okay? I'll add one fact, Mark, that you might not pick up by just reading a two-dimensional website, and this complements certainly what Tom just said. When we were sitting in the room with that same Meredith you were talking about a second ago and the rest of the Buckner team, we asked them what matters to you in this transaction or in this next phase of your company. And Meredith looked us in the eyes and said, around here, when somebody puts a piece of Buckner apparel on, whether it's a t-shirt or a ball cap or whatever the case may be, it means something. It's not just a shirt, it's not just a jacket, it's not just a Patagonia vest or whatever the case may be. They feel pride. They're proud of what we do, they're proud of what they're part of, and we're very worried that that would change. And when she said that, we knew we had something to offer them, and we knew they had something to offer us.
Great. Thank you, Mark. Zone 2. We have 2 zones.
All right.
One fancy.
Hi, Bill Nolan, shareholder, West Des Moines, Iowa. I don't know how many years, but it goes back to the West Marriott, the meetings there. So, I enjoy reading your annual report, and I'm going through it, and it's kind of the usual stuff, the 20 years of financials, combined ratio, 3 engines, kind of normal stuff. And then at the end, you have Paul Simon and the song Something So Right. And you've got his lyrics printed there. And it's kind of unusual, right? All the basic insurance stuff and then Paul Simon. So, and after the lyrics to Something So Right, you write, Markel, in its own singular way, is something so right. It works. So, just please explain.
Well, I was hoping it would be self-explanatory. I really was. And I think to a large degree it is. And if you look at that financial data, this is something so right. It's a record, a financial record of which we're proud, and we're glad you're partners. And I know you've been a long-term shareholder. There's a tendency in finance and in business and certainly engineering where you're always trying to quantify things and you're always trying to capture in a metric the thing that's going on. I would argue that the human spirit has an element that is unquantifiable. And one of the groups of people on planet Earth that do a great job of conveying meaning and importance that cannot be metricized or captured in a quantifiable way are artists. And the fundamental purpose of art, really good art, enduring art, and I would say Paul Simon qualifies as a durable, gifted by God artist, is the ability to convey truth through indirect means. And his music and his lyrics, to me, describe love and it describes accomplishment. I will recommend, if you've not listened to it, there's a podcast. It's about 5.5 hours long. It's called Miracle and Wonder. And my wife Susan was the one who, like Mark Hughes is one of the people who curates music for me in my life and tips me about things. And I have some friends who, tip me about things. And Susan was the one who found this particular one and said, you have to listen to it. And she was exactly right. And I've passed it along. But in today's world, and Buffett talked about it a little bit yesterday when he talked about tribalism and the rise of tribalism. And tribalism is a bad thing when it's taken to extreme and breaks the channels of moderation. In that Miracle and Wonder book, Paul Simon tells you the story of his life. And he grew up in Queens, and in, there was a Jewish community, there was a Jamaican community, I think. There were Korean communities. There were different communities that really were the melting pot of America. And if you listen to his music, he would say, he was following his ear. And of course, quite famously, he went to South Africa to do the Graceland album. He endured a lot of criticism about that, and I would invite you to listen to the podcast to hear the criticism. But I think his work is tremendous. I think it is a spirit of connection, of humanity, and the power of love, and the power of positivity. And much of what we do at Markel, oftentimes when people sort of, try to figure this company out, from the very beginning, the insurance was not the sort of thing that would be done in standard markets and commodity and easy and actuarially based. Those are all important, but we're willing to do that stuff and then take the next step where you might not have as much data, you might not have as much ability to quantify it. So you have to have this intangible positive force, and there is no more powerful one on planet Earth than love. So love and the power that it brings, poetry, music, art, that should be included in the fundamental description and aspect of a business. So that's one of the reasons why it's there. Another reason, and I'll tie it to what happened yesterday in the Berkshire meeting, he talked about Peter Lewis and Progressive a lot, and that topic came up, and there's a lot of things to be talked about, and I want to get to a lot of questions, so I'll try to be briefer about things. Buffett talked about the degree to which Peter Lewis was influential in helping him form his thoughts about Berkshire. Well, let me tell you something. Peter Lewis was actually very helpful to the Markels as well, the generation before us. And in the early days, we were agents of Progressive down in Alabama, places like that. And Peter Lewis and Alan Kirshner and whatnot were friendly, and they knew one another. And so Peter Lewis's thoughts were very influential and helpful to us. And here I will try to describe a little bit of self-maturation and process that's come along, because I started out life as an accountant. I remember reading Progressive reports a long time ago when Peter Lewis was still the CEO. And if I remember it exactly, he used to sign his reports, Peace, Love, and Joy, Peter Lewis. And as an accountant, I thought that was a little weird. But here's what I discerned and figured out over time, and it's really the underlying fundamental and architecture that drove the motivations of Progressive, and it's one of the reasons they've done so well over so long, and it's still the spirit that infuses them to this day. And that is, Peter Lewis was the first one who said, look, if you have an automobile accident, insurance companies will give you money to fix your car and get you the money and the financial stuff to set you back right. His insight was, money's just the intermediate thing. What you really wanted is the other day you were driving along, life was good, and then you were in an accident and your life got disrupted. What do I need to do to put you back in the condition you were in before you had an accident? And putting himself in the mindset and the emotion of somebody who's just been through an accident. And then he reverse engineered from there to pick the body shop for you rather than send you out there and replacement cars and just on, all those things that Progressive was an innovator on. That came from the fact that Peter Lewis, because he's an artistic kind of guy and not an accountant sort of oriented guy, he would have empathy to put himself in the position of his customers and build the company backwards from that. So that's what I'm trying to capture by introducing art, introducing music and things like that. But thanks for the question.
Right, you'd grown beyond an accountant, definitely.
I was never very good as an accountant, I can promise you. Sir.
Hi, good morning. Testing 1 million, 2 million, sorry. Thank you for your views last Friday at the Gabelli conference. It was really heartening to hear the anecdote of the guy from Markel Surety, and it just strengthens the conviction that I at least have in the company. I'm Michael Hilkens from Treasure Capital from the Netherlands and been a shareholder for 7 years. And first of all, I want to thank you all for your long dedication and your service to Markel and us as shareholders. Before you ask me to sing, let me ask the question. Venture started in 2005. You've grown it really at a great pace. It's been quite a success story. I believe return on equity or return on invested capital was like 24% based on maybe this year's or last year's earnings or your letter to shareholders at least. And I was just wondering, Markel is also known for doing the doubling the size of the company insurance takeover deals. I was just wondering, where is your future focus area? Is it a strategic point like Berkshire that the non-insurance subsidiaries become increasingly larger, or would that just be maybe a normal result of the highest convictions capital allocations that you can make?
Right. Well, het goed is the only Dutch I know, and barely know that. Let me ask my partner Richie to talk a little bit about the insurance acquisition side. And in fact, the story of John Knox came up at the Gabelli conference, and we have not talked about this, but I would invite Richie to tell his version of how that deal came to be, and you can see if our stories match up.
Well, so I'm supposed to tell the John Knox story?
Yeah, I think, yeah.
Okay. Well, yeah, that's a great story. John Knox, quite an entrepreneur, been in the surety part of the insurance world for decades, and one day reached out to us through a mutual friend and was like, hey, I'd love to come and meet you guys. And he was looking for a home for his surety operation that he had been building over the last decade or so. He wanted to stay for a period of time and make sure, that the people were taken care of and that it went well, but wanted a good home for his business. And so I think Tom would call it, we did a home and home. He came to visit us. We talked about it. It sounded interesting. He had, we could tell there was alignment of interest, there was alignment of culture and how we thought about the business. And then, so we said, hey, thank you, John, thank you for coming to see us. We'd like to come down and visit with you. And did that, spent the day with his team, met the rest of the people, very similar to a Metromont story or a Buckner story, just felt wonderful about the people and how well they would fit into the Markel organization. And before we left at the end of the day, we shook hands on a deal. And so
Word for word what you heard Friday.
So, that was, and it has been a spectacular deal. John was was as good as gold to his word. He stuck around for a few years. All the people basically have stayed. A business that was, I don't know, 75 million of surety premium when we bought it is now about 150 million with tremendous profitability. We do as many of those as we could ever find.
So thanks. I think that validates the story you heard from me on Friday, and it speaks to a couple things. One, that pattern, that process has been repeated around Markel many, many times, and it will likely be repeated into the future. So we don't know when the next call is going to come or where it's going to come from or what it's going to be, or whether it's an insurance business or a ventures business. The good thing about Markel is we are set up to enthusiastically respond to those calls when we see them, maybe even make some nudges and plant a few seeds and mutual friend kind of contacts. But we think if you did Venn diagrams of the opportunity set for Markel, well, one Venn diagram would be insurance, and the other Venn diagram would be non-insurance. And I'm not sure of anything that does not fall within those two Venn diagram circles. Thank you. Sir.
Yeah, good morning, Tom and team. John Dowling from Fairview Capital in Marin. Just want to ask you, Tom, about your sale of CarMax. What was your thinking behind that? Would you consider reinvesting now that the stock is down a lot, and particularly in light of the fact that we've looked at Carvana and we see chinks in the business model?
Right.
I think they have some problems, so just want to ask you about
All
that.
right, so starting off with that, obviously we would consider reinvesting because that's our job, to think about what good investments could be and allocate capital rationally and logically when we see opportunities to do so. So we do keep track of it. In March of 2020, the early days of the pandemic was when we did sell CarMax. Those were the early days of the pandemic. And obviously we went through the worst quarter we had ever had in our insurance operations in 90 years with the losses. And as Buffett talked about in that annual meeting at that time in real time, the dispersion of possible outcomes was wider than anything he had seen. And we would say the same thing. So as the Mario Andretti line from race car driving would say, to finish first, you must first finish. So we looked at each and every security that we owned, equity, fixed income, and we thought about the world and what was going on and our own capital position. We talked about it in the annual report this year, tried the distinctions of blue and orange capital and the internal calculations we would have made and rating agent discussion, on and on and on and on. And we took about 20% of the equity portfolio and liquidated that. Now, I can be appropriately and justly criticized for that because in hindsight, the governmental responses, the things the Fed did, so on and so forth, the outcomes that did actually happen were not as bad as what they could have been. We didn't know that at the time. And my first and foremost duty, I thought, was to make sure that no matter what happens, Markel is open for business the next day and the day after that and the day after that. And fortunately, the world healed. The insurance business has gone on to where we were able to write the next policy at very attractive prices, given the uncertainty out there. We had the pause button on equity investments for, 2 or 3 months or something like that. And then we started resuming the pattern of dollar cost averaging that we've done for years and years, and we continue to do that. You probably can't read the logo of the tie here, but this is Lansing Building Products, which we actually closed, what was it, in April of 2020? The deal had been agreed to a bit before that, but we did close. And that was some nail-biting stuff. It really was. Mike was kind enough to remind me of the movie Sully with Tom Hanks, flying that plane and making real-time decisions. And they're not all perfect. They are not. But we're open for business the next day. We're setting records. We closed a wonderful business with Lansing, which has exceeded every expectation we would have had for them, both financially and culturally. The values that Lansing has fit what we mentioned about Buckner, about Metromont, everything else. So, it was a fight, and then some bumps and not fun and some painful memories, but we're still here and getting it, and CarMax is on the list of things we think about. So thank you.
Yeah, thank you.
Sir.
My name is Vishal Patel from Toronto, Canada. I love reading your annual report. You specifically talk about the three buckets, the customer, the employee, and the shareholder. And this morning, you had your employees stand up, and it's great to have these great employees. And so my question really is about how do you think about talent acquisition, and specifically what's your process for interviewing candidates to join the corporation?
Do you have a resume?
That's kind of the time right now.
The number one way in which new talented colleagues join Markel is through relationships with people like this. And the 1 degree of separation where I know somebody and I know somebody and I know somebody. And if you yourself had a great experience at Markel, it is very logical and rational to bring in friends and neighbors and people who you like and trust and think are talented. So individual referral is a very strong pipeline for people to come into Markel. Secondly, hey, let's hold on to the people we have. Rich and I have both been at Markel for over 30 years, Mike 15 years. You have a lot of people who, and I think Alex Martin one time coined the phrase, maybe there was somebody working for you that had been there 6 months, and you said, but she's a lifer. He could tell within 6 months, this is somebody who had the passion, had the values, had the culture. So we look like Diogenes with a lamp for people like that, and then we try to get them as best we can, and we are who we are, and some people love that, and so they fight for it and they never leave. Other people, it's not their shtick, so they move on, and that's fine, and that's really 80% of it. Now that being said, and Sue would criticize me and say that I'm being remiss for not highlighting this, and we do it with insurance, we do it within the ventures businesses. We use the modern tools of technology. We recruit at colleges and universities in a systemic, progressive way. So we're doing that because sometimes you only know so many people, and the people you know only know so many people. You might need to meet some new people that you would not have otherwise encountered, and that's particularly important in today's day and age. So we embrace the tools and the technology and the techniques to begin to build bridges and develop relationships that would just set those natural pipelines in action. Sure.
Hello, my name is John Kruger. I'm from Bentonville, Arkansas, and I've been a shareholder for about 1.5 years. I really like how you guys have shifted your exposure in terms of the Nephila business. I was just wondering if you could walk me through the economics of that business and where you see that business going in the future.
Rich, if you take.
Sure. Nephila is a fantastic business. Our timing on purchasing it probably could have been a little bit better, just simply because the 5 years after that have been pretty tough in terms of the weather, and as a result, our results just have not been where we would have liked. But that's just a small part of the story. Nephila makes our combined insurance operations better. And you saw that with some of the things we did in terms of really turning over to the experts within our organization the underwriting of catastrophe risk. We basically took quite a bit of the catastrophe portfolio that was within our insurance and reinsurance business, and we have handed it over to Nephila because, quite honestly, we think they have the skill set to do a wonderful job with it. Obviously, the other piece of that is that removes that risk comes off of our balance sheet, that volatility comes off of our balance sheet, and there's investors out there who desire that risk, and it is non-correlating to the rest of their portfolios. They tend to put very tiny allocations in terms of the overall size of their portfolio into catastrophe risk or other things that we will probably be writing in the future. So right now, the business, we're about $9 billion of AUM, and at the $9 billion level, it's about a break-even business. But the business is incredibly scalable. Every $1 billion of AUM is going to be something on the order of 10 or so million to the bottom line. And so our goal and what we want to do this year and every year is produce great results for our investors such that they will entrust more of their assets to us, and we can grow that AUM. We have We have a wonderful platform at Nephila, and really, as we are able to scale it, it basically drops to the bottom line. So it's a beautiful part of the platform that we have built in our insurance engine that gives us capabilities that really, I can't think of anyone else who has the array of capabilities that we have in the specialty insurance marketplace. And I just think that will continue to make us better as an insurance organization over time.
I'll add, Tony Markel used to joke, obviously the key to running this business, running any business, is always be hiring people and adding people to your team who are better than you are. He says the discouraging thing is it seems so easy to do. So building on the talent question, the talent levels at Nephila to underwrite catastrophe risk are very high. So they brought a skill level and a dimension to Markel that takes our game up a notch. And we do that all the time, continuously, throughout the organization, all the time. Better, faster, cheaper is win-win-win. It helps the customer win, it helps us win, it helps the talent, the employees of Markel win, all at the same time. So that, I wanted to say specifically about Nephila, but it applies globally across the business. The other thing that ties maybe to a broader issue of capital allocation is, when we're looking at deals like this and when we're making any capital allocation decision. I've written about our capital allocation philosophy and our triage and whatnot, but there was a piece that Tyler Brown shared with me within the last 2 weeks from some source that I thought added a very nice dimension and thought. And we had done it intuitively without really articulating it and thinking about it, but it was a good articulation. And think about two axes of a graph, and on one axis you have optionality, and the other axis you have resilience. So there are sometimes when you're buying something, and frankly, when we're buying Buckner or Metromont, I can assure you that no matter how sexy I make a piece of precast concrete sound, I don't think anybody in the room here is going to buy one that hasn't planned to otherwise buy it anyway. Yeah. It's just, the business is not going to change. There are certain base levels of load that exist for how much precast concrete you have, and if you bought a big chunk of it, your neighbors would complain. So it's just not going to happen. But it's resilient, and over any given 5-year chunk of time, I feel pretty confident about what the demand for precast concrete is going to be, and Metromont's market share. So it's the sort of thing that's dependable. You can count on. So that's high on the resiliency side of things, but not that much on the optionality side of things. Nephila, obviously the resiliency is something that, we worried about a little bit, and in other things in ILS, I can report to you, and you already know, it wasn't resilient at all. But there's huge optionality.
Yeah, right.
And economically, Richie described it quite correctly, is that, once you get past the break-even level, and I suspect there are a lot of people in this room who operate money management businesses, and you know how the economics work. Mm-hmm. Once you pay the rent and the electricity bill and the subscriptions, everything else is very highly incrementally profitable.
Right.
Well, Nephila is the same way. So there's huge optionality there. We've been operating in an environment where the losses have outrun the iterative process of raising prices. But we keep raising prices, and assuming there's some cyclicality to the losses, well, you'll hit a fat part of the curve where that profitability manifests itself, and you'll see it. So you root for that day, so do we.
Yes.
It'll happen.
Yes.
And generally speaking, it's been my observation that when that happens, investors want more of it, and they chase that performance. And I would suspect the AUM will increase following a period of good returns in the same way that it's been chipped away at during a period of low returns. So,
Got it. Thank you.
Thank you.
Hi, good morning. I'm Han Kun, and I'm from Winnipeg. I've been a shareholder of this company for around 2 years. So my question is that in our first letter to shareholder, the company said our long-range goal is to continue growth, our growth at a rate of at least 20% per year and earn an annual return on equity in excess of 20%. So my question is, as our company scale more and more, is this goal still achievable? And what's our advantage and disadvantage of scaling up?
Right. Well, thank you for the question. That letter was written by Steve Markel back in 1986. And in 1986, if we have any financial historians here, I do not know what the 30-year government rate would have been at that time. Looking at my colleague Dan Gertner, because he's the keeper. Higher. Yeah, a lot higher. So the
A lot higher.
the base rates of return nominally were much higher than they are right now. So when you penciled out the math of what would happen, and in fact, at that point, the underwriting profitability targets and expectation would have been 99 or 98 or something like that, because you could have invested the money at high rates of return in government securities before you stretched and did equities or anything like that, and the leverage ratio at which you were able to operate in the regulatory environment that existed at the time, that number penciled out. Now, Steve and I used to argue about that a lot. And Steve and I argue about stuff all the time. That's the nature of the way Steve likes to discern the truth as best he can, is to argue about it to see if we can find some rabbinical process to discern truth. And I used to push back at him all the time. And I tell the story that, in Richmond, Virginia, when our kids were coming up, and there was a department store in the era that there were department stores called Miller and Rhodes. And Miller and Rhodes had a Santa Claus that was legendary. And people would come and they would line up and they would be in line for hours to see this Santa Claus. And I wondered, and we did it too, and I wonder as a parent, why did they go see this Santa Claus? There was another department store right across the street called Tallheimer's. You could waltz in and out and see the Tallheimer Santa in a minute and a half. Why wait in line for the Miller and Rhodes Santa? Well, I think one of the reasons was that there was this process by which the Snow Queen would greet the child, and she would find out the child's name. And obviously she had a radio and would tell Santa what the child's name was. So when the child was coming up to see Santa, they were greeted by name. Very important, makes the child feel good. And then the kid oftentimes would ask for the toy or whatnot. And what that Santa would say was, "I'll do the best I can. I'll do the best I can." And as a parent, I am deeply grateful to that Santa. Because that Santa did not put me on the hook, or more importantly, put Susan on the hook for acquiring the hot toy of the day. And what we pledge to you is we will do the best we can. Now, in 1986, Steve put numbers down on a piece of paper, which apparently will live forever. And but what we will do is the best we can. And then it'll be what it'll be. And I hope you and I will both be happy with that.
Thank you very much.
Thank you.
Thank you.
Good morning. My name is Cornelis Kick from Hamburg, Germany. My question goes along the similar lines of the previous questioner. I would like to know what the intended destination for Markel is in 10 to 20 years from now, and what the management is doing in the present to reach to raise the probabilities of reaching that destination.
Well,
Thank
certainly.
you.
And thank you. That's a thoughtful question and asked in good terms. We want the company to be better. We want the wins for the employees to be more. We want the wins for the customers to be more. And as such, if we do that, the wins for the shareholders will be more. I will not put too much of a number on it, other than I like math I can do in my head and thinking about things. So in 1986, the company went public at roughly $8 a share. Let's call it that. And think about doubles. So 8, 16, 32, 64, 128, 256, 512, 1,024. And so we're a little bit above that, so call it 8 1/4 doubles or something like that. Well, we went public in 1986, so what's that, 36 years between that? A double, if you doubled in 5 years, rule of 72, that means you're compounding at 15% a year, roughly. If you're compounding at 12% a year, that's 7 years. So you take 8 times 7, what's that, 42. The doubling process of rates of return using rules of 2. We've basically been in that, doubling every 5 to 7 years in the share price, but also the size and scale of the insurance business, now the size and scale of the ventures business. And if we stay in that corridor in a range of interest rates and investment returns and returns on capital in broad aggregate terms that are sort of in that corridor to make this business twice as good as it is today, in the course of 5 or 7 years, we're we're doing the best we can, and that is a spectacular outcome. And it's a spectacular outcome as the company continues to grow in size and scale. Size and scale both makes it harder, just because you're having a bigger number that you're working with, and there does come a time when that reaches some limit. I think we're a long way from our size being at the point where we're really bumping up against ceilings. Size also brings advantages. We get invited into conversations and have deal flow that we couldn't have dreamed of 15, 20 years ago. I mean, people talk to us, to use rough terms. I have a friend who, he's probably in his 50s, and he's a divorced gentleman, and he says, it's really great to go back to high school reunions, college reunions at this point, being a 50-year-old divorced guy, because 50-year-old divorced women will now talk to him that were not willing to talk to him when they were both in school at the time. And there just comes a certain passage of time and scale where you get chances you didn't otherwise have. And Markel is in that position these days, and I think will continue to be so.
Are you saying we're a 50-year-old divorced man?
I'm trying very hard not to be. The 50-year-old thing, I have to let go of that, but divorce, no.
Tom, you'd say, if I may, I was sitting with Alan Kirshner just a couple of weeks ago, Richie and Tom's predecessor and CEO of Markel for a long time, and he was reflecting on his legacy and a lot of what he had accomplished here at Markel, and he used the word builder. He felt like that was the definition of his career and legacy, is that he had been a builder. And I think he left that, and we aspire to carry on in that tradition. And Tom, you're the one who's frequently used the catchphrase that we're building one of the world's great companies. And that doubling and doubling and doubling again is really just a quantitative reflection of our aspiration to just build something great.
Yep. It's a lot of fun.
Hi, Chad Garcia from Naples, Florida, shareholder. What attracted you to VSC Fire and Security, and what part of the revenue is comprised of recurring service type revenue as opposed to project-based revenue?
I'm sorry, attracted us to?
VSC.
Oh, VSC. Yeah. Oh, well, here we have the CEO of VSC here with us. It's a great business. Mike, you're more than welcome to come up here and make a comment or go to one of the microphones if you'd like to. There's with codes, with safety, with just basic human behavior, you don't build a building like this without fire safety equipment in it. So there's both construction revenues and there's recurring service and maintenance revenues. Mike, the founder of VSC, was a person from Richmond who was well known to the Markels and well known to us as an organization. The conversations that had gone back and forth between Markel and VSC were 6-7 years between the first conversation ever and a deal closing. So it's a wonderful business, and I'll let Mike say a word of you.
Thank you, Tom. Ultimately, it was the people, it was the reputation, and the business side of it took care of itself. We're a very brick-by-brick company and 63 years old. But the way they run their organization was the way we ran our organization. And it's a very decentralized structure. We do the same thing. There was tremendous symmetry on a lot of levels, and the relationship has been amazing. And the opportunities in our industry, just like you, we are having opportunities come to us. Yeah. And we're grateful.
Great, thank you. Well, I think you sold Zone 2's microphone, so we'll double up on Zone 1. Next question over here. He stole it, but he's going to give it back. Yeah. Thank you.
Hi, I'm Ketcher Salazar. I'm a student at Archbishop Spalding High School in Maryland. So Warren Buffett typically stays away from these, high-growth, early-stage tech stocks that have recently IPO'd. But recently, he's taken some small stakes in Nubank, a Brazilian fintech company, and Snowflake, a cloud company. So considering the similar investment mindsets of Berkshire and Markel, would these small steps of Berkshire's make you more inclined to look at growth in tech companies?
I'm not qualified to speak for Buffett and his capital allocation decisions. He's pretty good at it, so I'll let him speak for himself. What I would say is that in that axis of optionality versus resilience, we've always thought about optionality. We would love things to be big and wonderful and grow that don't have capital constraints, which is often one of the features of something like in the fintech world. So we look at a lot of things like that and are aware of deal flow. And in fact, we have embedded within our organization some startup things that we don't have to make a press release about it. We don't have to buy it. We just back people within the organization. Rich, you want to add anything on that?
No, nothing.
Yeah. So we're open-minded and aware of the dynamics. Thank you.
Hi, Daryl Newcomb, for a student in the universe, currently living in Pittsburgh. Thanks a lot for going to work for us every day, or most days. Shareholder for the past 15 years. There were some tough years with the kind of insurance business with the CatCo in the last few years. Not trying to dwell on that, but I was looking for some insights into kind of what frequency do you think we should expect underwriting losses as long-term shareholders, knowing those are gonna happen occasionally, is it maybe 3 out of 10 years or 1 to 2 out of 12 going forward in the next 10, 15 years?
Great. Well, let me take a first statement and then ask Richie to join in as well. And let me correct one error that I forgot when I was starting off the meeting in housekeeping items. We're glad you all are here, just in case, or if you'd like to make the trip. The Markel annual meeting itself is on May 11th in Richmond, Virginia. So any of you who would like to come to that, please, you are invited, and we would love to see you in Richmond on May 11th. To get to the point of CatCo or underwriting losses or Markel Ventures deals that don't work out, we are an organization that makes mistakes. Period, paragraph. And as Alan Kirshner would have said, it's okay to make a mistake. Now, he would also follow it up with saying, don't make the same dumbass mistake over and over again. But that is so important because people are afraid to make mistakes. And I don't know how to live a life that's worthwhile that doesn't include making some mistakes. And I don't know how to learn without learning some things the hard way. If I was smarter or better, maybe I could learn entirely from reading about something or observing somebody else's mistake. The old joke is that smart people learn from other people's mistakes, average people learn from their own mistakes, and dumb people don't learn from any mistake. So we're trying not to at least be dumb. We want to at least be average, and we want to be studious enough and learning enough so that we learn from some other people's mistakes as well by reading. So if you look at the history of Markel, there have been long lists of things which you can accurately describe as a mistake, but there's an even longer list of things we've learned by doing it, and the organization is more robust and resilient and bigger and better because we were willing to go down learning curves, sometimes some of which are painful.
Yeah, and maybe just talking more specifically to underwriting profitability. Our goal every year is to produce an underwriting profit. And obviously, the gentleman was talking about in the first annual report, based on what the market was then, a 99 combined got us to a 20% return on equity. So, but different world now. We need to be 90, 89 combined to generate appropriate returns for shareholders. I just quickly looked in the annual report because I'm an accountant too, and I can't remember any numbers. I just have to face facts. Looks like we've had 5 years out of the last 20 where we were over 100 combined, and in each of those years it was down to one of two things. 2 of the years were because of acquisitions. We did the acquisition of Terra Nova. That took us a little time to work through. It might have initially been classified as a mistake. I can tell you today, with the fullness of time, it was not a mistake, but we had to take some pain those first couple of years. The other 3 years would be as a result of cat activity, hurricanes, earthquakes, you name it. As we go forward, one of the things we've done, and we talked about earlier, is we have reduced the volatility on Markel's balance sheet as it relates to catastrophe losses. So as we go forward, I would hope we would do better than 15 out of the next 20 years in an underwriting profit. I would hope that would be much closer to 20 out of 20 years. I would never be bold enough to tell you we will do 20 out of 20 years.
I would say, and we write about it in the annual report, the 5-year buckets. And I think it is so valuable to extend your time horizon and think about things beyond months and quarters and even years. But 5 years is a marker we use for a lot of stuff. I'm guessing there's never been a 5-year period that if you did the cumulative 5-year results, we had earned an underwriting profit.
Yeah, no, absolutely.
Yeah.
Morning, Tom. Thank you for the invitation. People call you a mini Berkshire Hathaway. I think the job well deserved. Let me introduce myself by saying maybe I'm Markel Corporation. I'm a money manager. My name is Bhuvan Gupta. I'm from Dubai. And my question is on the financial balance sheets, basically. So I have been asked this question. So I have 2 questions here. One is that who is ultimately responsible for the balance sheet fraud? Is it the auditor or the fund manager? Second, what are your top 3 filters while finding the financial balance sheet frauds?
I'm sorry to make sure I understand your question. Who is responsible for balance sheet fraud?
Yeah, the auditor or the fund manager.
Well,
and what are the top 3 filters to find the financial frauds while selecting a company?
Sure. Well, the people who would ultimately be responsible are Richie and myself. We are the CEOs of the Markel Corporation, and we sign the financial statements and put our personal signatures there, that to the best of our understanding and ability, these financial statements represent fairly the financial condition of Markel. Our asses are in the sling. As a consequence, every human ability that we have to make sure that is not the case, we expend. Now, fortunately, both of us have been here more than 30 years. We're not in and out guys. We have invested our careers, our lifestyles, our identities in the ongoing success and financial integrity of the Markel Corporation. And we will do our very best to make sure that people who follow us in these roles have the same underlying values and ways of thinking as what we do. And all process, auditing, public accounting, internal controls, they are all tools that are designed to help and create attestation about that. But that stops and starts here. Yeah.
Thank you.
Thank you.
Hi, Ron Mast from Santa Monica, and shareholder since 2018. With the growth in private equity and the higher enterprise value EBITDA multiples generally in private equity, but also higher valuations in public equity, can you talk about what you see as reasonable long-term returns on equity from the private and public equity portfolio? And have you, in response to that, have you changed your allocation between private and public, or do you think you would? And also, Warren talked about his cash balances. They had been running much higher in recent years. How you think about valuations and the cash balance that you'd like to run at Markel?
Right. Thank you. And our cash balance has been running high as well, and that is a high-class problem to have. So we like having a problem like that. In terms of our return on capital expectations, we have a wonderful circumstance here, which is set up by the architecture. So we have an insurance business, we have the ventures business, we have the public investment portfolio, and we have the ability to repurchase Markel shares. And all of those are subject to the same test. And if you wanted to put a number on it, anytime we expend $1, we would expect to earn double-digit returns on that. If we don't have the expectation of a double-digit return, we'll then hold on to it. And that probably is a temporary decision because double-digit opportunities do come along. And I think as fellow shareholders, you should expect, and frankly, our incentive compensation is based upon us exceeding earning the double-digit return measured over 5-year periods. And that's been consistent for a long period of time. The hurdle rate used to be, in the mid-teens before we get any incentive compensation. Now it's at 10, for the full payout of that sort of bonus, and that's an acknowledgement of the fact that the overall levels of investment return for everybody, not just Markel, are lower in the lower rate environment. But our internal mentality would be if we're not going to get double digits on it, just hold on to the money and wait.
Most of all,
Thank you.
I hope you all appreciate the gift that you give to us as managers of the business. And this ties back to the question before about the growth of Markel Ventures, the growth of insurance. We sat in a room, let's see, maybe the spring of 2008, right after the formation of Parkland Ventures, and we formed, which Susan runs. Tom mentioned that earlier. And we formed that company with the intention to go add communities and buy communities for them to manage. And I remember, I'm sure you remember this too, management asked in that very first board meeting that we had, how many communities do we need to acquire this year? And Tom said, I don't know. Maybe none, maybe a lot, just don't buy any stupid ones. Not everybody has the luxury of operating in that manner, and it's part of our daily thinking. I remember a conversation, and sorry, this would be the double dog on the private equity guys, but a conversation with a private equity fund manager, and his direct quote was, as we were talking about looking for investments and the market's expensive, et cetera, et cetera, et cetera, and he said, you know, the thing is, we're at the tail end of the fund. I still have 20% to get out there, and honestly, I would buy anything I could get my hands on. We've never operated that way, and that's because of you, and we have the flexibility to do whatever makes sense in any given moment.
And by the way, one of the reasons we don't operate that way is because in addition to being stewards of your money, it's our money too.
Yeah, no kidding.
Sorry.
Yeah, g'day. What are some books you guys would recommend?
I'm sorry?
What are some books you guys would recommend?
Well, I'm going to recommend your director's book, Morgan Housel, The Psychology of Money. It really is a good book. And somebody asked me, so it's sort of like when we first became aware of Brahman and the opportunity to potentially acquire Brahman, not being a handbag expert personally, I went home and I asked my wife Susan, I said, hey, have you ever heard of Brahman handbags? And she says, oh yeah, I have 2 of them. And she proceeded to show me her 2 that she owned. Well, Susan is a chemical engineer by training. She runs a manufactured housing business. She's tough and pretty thoughtful with her expenditures. So the fact that independently she had acquired those handbags before there were any Markel biases involved was something that skewed me in the favor of Brahman and looking at it favorably. So, Psychology of Money. I've known Morgan for multiple years, and he's known me, and he's known Markel. In fact, when he worked at the Motley Fool a number of years ago, I don't know how many years this goes back, Motley Fool, in order part of their culture and make sure people own stock and whatnot, they give you some money to pick a stock with. And before he and I had ever crossed paths, he bought Markel. So I read his blog, got to know him, and this has been going on for years. And when that book came out, that was a catalyst, and we had a board opportunity. So the conversations kept going up. And I will say this story about Morgan. So I went out to Seattle to visit him. When we were sort of ramping this up and talking about the board conversations. And Morgan, I'm going to disclose some HIPAA violation material here but they could find it in the public record. You're 38 years old, or at least you were at the time. And he says, so why are you asking me at only 38 years old? And I looked across the tortilla soup that we were eating, and I said, you are the oldest 38-year-old guy I've ever met in my life. The wisdom in that book from a 38-year-old really is quite something. And again, long before he joined the board, we talk about books all the time in our family, and once a year at Christmas time, I give my children a book, and usually there's a financial gift as well, so they kind of have to read it. It's a homework assignment. When Psychology of Money came out, that was the Christmas book that year that I wanted my children to read it. So that's one book I would recommend. Second book, and I read constantly, that I've talked about is there's a book called The Long Gray Line by Rick Atkinson. It's about the class of 1966 at West Point. And my takeaway of that, and the one phrase I would say, is that there are certain kinds of mistakes that only experts can make. So if the experts who had every degree from every university in the world back in D.C. had listened to the people who were on the ground in Vietnam, I think decisions would have been very different. And so I would encourage you to read the book for many, many, many reasons, but not the least of which is, understand the limits of expertise. And when people assert knowledge or they assert training or they assert but so much, have a little healthy degree of skepticism about that. I've not read the book yet. I know Susan has started it. Roger Lowenstein's new book about financing in the Civil War, Ways and Means. I've read everything else Roger's ever written, and I recommend he's a great author. He was one of the 6 guys there at that first brunch, so I need to recommend his books as well. Any other?
You gave me a book in the last 6 months or so, just because you know how big a fan I am of the business, but Founding Trader Joe's, which is a phenomenal story, and I think important for us to read. If your career or your daily responsibilities don't involve running a business day to day in the action, and that is certainly true in many respects for the Markel Ventures team anyway. We're there to support the people who are doing that, and reading a story about what it takes day to day to thrive and succeed in a business, and the entrepreneurial spirit and the constant zigging and zagging, the daily problems that show up on your desk. One, it reminds us that we don't know the answers, and it reminds us our role of giving guys like Mike, like Susan, like Ben, who are here today, and other owners of the business, the space and the applause and the gratitude for figuring those kinds of things out. There was a phenomenal book about an incredible business.
And Rich is too modest to talk about his book reading habits, but there's one that he gave to me at one point in time called Everything I Need to Know I Learned from the Grateful Dead.
Yeah, that's a great book. Highly recommend it.
Hi there, Russell Crouch, Nashville, Tennessee. Been a shareholder since about 2013, and my sons picked up some shares in April 2020, thanks to the market big drop, so I appreciate that. My question is about the equity portfolio that you have. You've got about 57 or 58 holdings. I know not to compare to Berkshire, he has 47, but Buffett has like 70% of his holdings in the top 5, and you're a bit more diffuse. I was just curious if you'd ever considered shrinking the portfolio and focusing on your, top 5 or 10 with more capital allocated to the best ideas that you have versus a bit more diffuse.
Sure. Well, first off, it's important for me to acknowledge, and I think on behalf of being a steward of you as a shareholder, I'm just going to, this might be breaking news to you, but Warren Buffett is smarter than I am. So, the degree of sort of confidence and skill and risk that you're taking by getting the list smaller and smaller, it goes up. Now, that being said, just to get the facts right, the top 20 holdings that we would have are probably about 2/3 of the value. So it really is more concentrated when you talk about the dollar weighting of things than the number of names. And both through active capital allocation and through things that are working, becoming more and more mathematically of the portfolio, and the things not working becoming less and less, we're always sort of trending and leaning that way. But as is the case throughout a lot of our stuff, we like to be very methodical, very brick by brick, very tomorrow and the day after that and the day after that and the day after that, rather than claiming expertise and being as much of an expert as what he is. And over the long run of time, it's worked out pretty well. I've been running the equity portfolio for 32 years now, and we're 150 basis points ahead of the S&P for 32 years. And we have someone in the audience named Shelby Davis, who I see right there. And I can remember Shelby as he was leaving the era of being publicly measured on his investment returns, and he had compiled a 30-year record like that of outperforming the S&P, which, again, you're in the pantheon of superstars if you do that for that kind of period of time. As he decided to manage his own money and do things philanthropically rather than through the mutual fund, he said, that is a record that they can never take away from me. So we are very proud and grateful and appreciate the assistance of so many people in this room who've been so helpful to me in managing the portfolio in such a way that we've earned pretty good returns for a long period of time, and you're just going to have to accept my own limitations and the fact that I'm not as smart as Buffett, so those bets are going to be spread around a little bit more. Thank you.
Hello, my name is Ram, individual investor from Dallas. You know you're going to get a question on inflation. So one is back in March, like you mentioned earlier, everybody had to stress test their portfolios for what's going to happen to their holdings if revenue dries up for a certain number of quarters and the costs are not going to go down that much. Similarly, while acknowledging that nobody knows what's going to happen to the inflation in the next few years, it also doesn't look as good as the last decade or so. So when it comes to equity holdings, how are you thinking about stress testing for inflation, where costs going to go up and revenue demand might wane? Again, I know that most of the major holdings are highly durable, pricing power and stuff, but even with probable high inflation, how are you thinking about how to adjust the holdings, or are there other opportunities it might open up?
All right, well, thank you. The question is about inflation. And as Buffett said yesterday, inflation swindles everybody. Inflation is a hard headwind to face in every dimension. Now, one feature about Markel, so another thing Buffett said is we don't believe anybody's forecast, including our own. His own appropriate acknowledgement of humility and the limitations of experts. So anybody who tells you what inflation is going to be, I wouldn't believe any of it. Now, here's an advantage that Markel has given the nature and structure of our business. The presence of Markel Ventures gives us monthly financial statement reporting and as much as daily interaction sometime in the real world operations of real world businesses. And I didn't need a single government statistic to tell me 2 years ago that inflation was brewing. And we were facing cost pressures just in the running of our business. If we never read the paper, if we never looked at the news, if we never looked at any government statistic, I could have told you that the price of poker is going up because I see it from the interaction with our operating businesses. So I'm not relying on forecasts. As Groucho Marx says, who are you going to believe, me or your own eyes? We had our own eyes to look at and see that inflation was growing. The CEOs of the business, so you got Mike and Susan here and Ben, they would have consistently heard from me like, so what are you doing about prices? What are you doing about prices? And pushing price because you have to in order to continue to operate the business. We've been doing that for a while. And similarly, within the equity portfolio, we want to have companies that are as able to pass on costs as much as possible. And Dan Gertner has been keeping this chart for me for many, many years. And it grew out of a conversation he and I had, and there's much conversation about oil and what's going on in oil prices. Well, the chart that Dan keeps for me is the price of a barrel of oil since 1974 and the price of a single-day admission ticket at Disney World since 1974. Now, I don't know the exact numbers, but today, what's the price of oil sell for? What's a barrel? 105? Okay. It costs more than that to go to Disney World. In 1974, the single-day admission ticket was $3.50 at Disney World. I don't know what the price of oil was back then, but I think it was more than $3.50. So actually, the nominal cost of a single-day admission ticket at Disney World has risen at a faster rate than that of a price of a barrel of oil. And the double-barreled, to create a pun advantage, is that when you are selling oil, you have a reinvestment challenge and that you need to find a new incremental barrel of oil because that one doesn't replace itself. As Buffett wrote, Disney is like a business where you're selling oil and the oil keeps seeping back into the wells. So their ability to continue to repurpose and use the characters they come up with for a ride or a book or a movie or a costume or the basis of a restaurant, on and on and on and on and on and on. And I won't specifically endorse Disney, but I would say take a look at it because there's things that caused it to go in and out of favor, and let's just say that the preponderance of things that people would be skeptical about is higher right now in that case than it would be. But we've owned that stock for a long, long time, and I think they are emblematic and possess many of the characteristics that whether inflation is 2%, 7%, 15%, or incalculable, if you want to go to Disney World, you got to pay what it costs.
Yeah, just a small follow-up question. I know we have seen a lot of market craziness in the last 2 years, GameStop and others. But what lessons do you take away from all the craziness, and either reinforcing the Markel mindset of long-term and common sense, or
Yes.
any new lessons?
I would say there has been a lot of market craziness in the last few years, and what that teaches me is there will be market craziness in the next few years as well. Be prepared and adaptable no matter what comes at you. Thank you.
Hey, good morning. My name is Alexander Chan. I'm a recent graduate of UCLA and also a data science by trade. I'm a prospective shareholder of Markel. Two main follow-up questions were with the last question about the large number of holdings you guys have. First, what is the purpose of the long tail of small holdings? Is it to maintain a psychological effect to keep an eye on these companies? And second question is, can you talk more about your investment practice? How does Markel keep track of so many companies? Do you guys have a manager for each group of companies, or do you have a manager for each group of companies? And then how do you make sure all these risks are aligned with the overall portfolio?
Well, a couple questions there, and let me take them. So the reason for the long list is exactly as you said. There was a woman named Stephanie Bass who used to you'd be here. She was with her body, and her technical term for that was library cards. So I got a library card, and that just as a personal matter, I find myself that I'm intellectually more interested in something if I own a little of it than if I own none of it. It's like betting $10 on a basketball game between two schools that I don't even know where they are. I mean, I wouldn't care, but I did put a $10 bet down, so now I'm going to watch the game. So that's the same sort of thing that I learn and have interest in on account of that technique. Again, when you really do have conviction about something, it is important to back that up, and that's why the top 20 holdings are 2/3 of the portfolio. And to some degree, carrying forward the sports analogy, it's like a major league roster for a baseball team. So you have the major league team, you have the AAA, you have the AA, you have the single A. And the way major teams operate is, they start somebody out, and if they do well, they go up the roster, and if they don't do so well, they go down. Same process. Technically, the way that works is Tyler Brown, Dan Gertner, and myself, have the direct portfolio management responsibility for those holdings. But here, let me let you in on something. The great, great, great news is that for over 30 years, at the time we've been coming here, I've always told people, and Chuck is a great example of this, the ironic thing is you're smarter than I am, but I'm managing money for you. So I have this unpaid volunteer staff of adjunct advisors who, own Markel stock in their own portfolios. They're my friends and their colleagues. And we talk, we meet at these kinds of gatherings. And I always tell them, I said, look, what we own is public. Look at the 13F, it's out there, you can see it. If there's something that I'm doing that's stupid, tell me. And my friends are not bashful about telling me, how dumb they think I am at any given point in time. So, I hear that and I listen to it and I take it very seriously. And similarly, if there's something that I'm not doing that I should, suggest it. Let me know. And I try to reciprocate that. So, win-win. That's a win for that person who is a shareholder of Markel because I listen and I try to learn something from them. It's a win for them because, again, this is public information. It's not inside stuff. We talk about that and the nature of being able to have robust, frank discussions. And the feedback loop that you get from that has inured to the benefit of this company for a long time. And I love that. It's fun. That's how it works.
Yeah. Thank you.
Hi, nice to meet you, Tom. Thank you for the invite.
Thank you.
My name is Ankit Patel from California, Northern California, Silicon Valley specifically. So I'm just learning about Markel. And so I was reading the investment engine section of the annual report. I'm wondering about the investment philosophy, whether it's value or growth. And as you said, let's just specifically ask you about a stock. So specifically, Amazon is a large holding. Is that value, growth? How do you see it?
Well, I think the distinction between value and growth is a false distinction. Everything is value investing. And if you read first edition of Graham, Ben Graham would have said, and it's really more clear in the first edition than many of the subsequent editions, growth is an element of value. It's just harder to calculate. And you can't put hard, fast numbers on it, but it is what will dominate your future returns. So the value of any security is the net present value of the future cash streams. Period, paragraph, that's it. And so value and growth is something that's used in the investment industry. It's not used by us as we think about what we're owning. We're thinking about businesses and what we're paying for that business today. And frankly, from a tax point of view, if nothing else, as well as many other dimensions, if we are able to buy something and hold on to it because it grows over a long period of time and not trying to trade and realize capital gains, then we get the tax deferral of that unrealized gain, which at this point is, I don't know, $4 or $5 billion, something like that, which is a zero interest loan from the government. And with interest rates going up, to have a zero interest loan from the government and the deferred tax liability, that is a very good thing. And for Markel shareholders, you're trying to understand Markel. Among the attributes of this company, and you can describe it as an insurance company, you can describe it as a conglomerate, you can describe it as a publicly traded family office, which I would to some degree. You can also think of it as a super after-tax IRA, because if you own Markel shares, and those shares represent this business, which is compounding in value, and there's tax that's paid when we earn money and the operating income of the businesses or the realized gains, but you as a shareholder don't get a tax bill for that until you decide you want to pay it when you sell the shares. Meantime, you can compound and defer that on a tax-deferred basis. And over a long period of time, it isn't just Warren Buffett who knows that. Look at John Malone at Liberty and all the things that he's done. It's a way in which value is created for Markel shareholders, the overall structure that we have.
Specifically Amazon? I don't know if you have a comment about Amazon.
We own it. We love it. And as my assistant Cynthia Fetterman will say, I'm an Amazon addict. I mean, there's probably 3 boxes a day that are coming. In fact, I sort of treat myself half the time. I mean, because a friend will tell me about a book or this or that or whatnot. So yeah, order it. And I forget what I ordered by the time it gets there. So after 2 or 3 days a week, it's my birthday. So I love it.
Thank you. Hi, my name is Edward. I'm from San Jose, California. I noticed in the 10Ks that goodwill has continued to increase year over year on your balance sheets to the point where it represents about 20% of your assets. The percentages were also pretty similar in 2020. GAAP rules require you to keep testing this value annually, but you use a subjective market calculation to evaluate this. Furthermore, it appears there are many parts of the 10K with high levels of depreciation and amortization. Even when you calculate operating EBITDA, it's about 33% of your recovered calculations. How are you so confident that you are not overpaying for your latest acquisitions or the risk is manageable? And can you lend any insight into your fair market value calculations with regards to this high amount of depreciation and amortization? Also, regarding your earlier comment about Diogenes, I certainly hope you're not taking his lifestyle too far. I can see you're not wearing rags, but a wine barrel in the street might be a little bit much.
Well, you never know. That's got to be flexible. Thanks for the question, and I think it's a mark of a good analyst that you would zero in on some of those sorts of things. The first thing I would do if I was in your shoes is I would split Markel into sort of the financial businesses and the non-financial businesses. And the position of intangible assets and goodwill when you're operating in the regulated world of some of our financial businesses, that's different than what is the case of goodwill that arises from us for paying more than tangible book value for a industrial or service business. So in our financial businesses, the goodwill calculation is pretty straightforward. It's pretty straightforward to keep track of that. Anytime we do an acquisition, there's almost always goodwill involved, and that's where it comes from. For the vast majority of our acquisitions, they have worked out very, very well. For the ones that haven't, we've written off the goodwill that's associated with it pretty much as soon as we knew it didn't work. So that's the case there. And you have to keep your regulators on side and keep communicating with them and walking them through your math on a regular basis. That's normal, ongoing course of business for us. In terms of the Markel Ventures types of acquisitions, I think it's almost inevitable that any of the businesses we have, which tend, I mean, look at Mike's business, VSC, as a prime example. I mean, there are some trucks and there's some equipment, but what really matters is the expertise of what the people of VSC bring to the table and the cash that they generate because of their expertise. That's not a tangible asset which you can have on your balance sheet. It just creates cash flows. So to buy a business like that, you sort of are going to pay a premium to the value of the trucks and the buildings and the office equipment to get that. And as long as the returns are somewhat in keeping with that, you know, what you pay under current rules of accounting, which change, that goodwill is just going to be there indefinitely. And really, the more of it that's there, the more I like it. In the financial world, goodwill makes people nervous.
Yeah.
Because it's a tighter dispersion, and there's only a certain amount, and we're well within the lines of that. But I understand what you're saying. As Markel Ventures continues to grow as a relative piece of all of Markel, goodwill might grow, but that's not something that has implications for the financial business. It's what we think as shareholders we should do. So I don't really think about it much more than that.
I mean, the simple math on the non-financial side would be it'd be really tough over time to earn good returns on capital and have overvalued the goodwill.
Right.
If we're getting good returns, then it's a reasonable number.
And we've got a bunch of questions here, and it's coming up on noon time, so I want to keep going. Thank you.
Hi. Earlier, just before the pandemic, I recall that Markel had reasonable positions in both Marriott and United Healthcare. Would it be possible for you to share your thoughts today on both those two stocks, because they were stocks that had very sizable positions in the Markel portfolio just before everything started?
Right. Diamond Healthcare was actually not a publicly traded company. That was part of the Markel Ventures. It was an operating business. As we've said many times, we've not covered ourselves in glory in the realm of healthcare, so we ended up contributing that to a joint venture of some people who we thought had more expertise than what we did. We just, we said no mas, we can't keep going there. So that's what happened to Diamond. Marriott,
So it's worked out far better for the business.
Exactly. The business is doing much better under new hands. They were better at running it than we were. So you got to acknowledge that and move on. Marriott was like the earlier question about CarMax. It was part of the first quarter of 2020 review when we were just looking at every single thing with a weathered eye. Obviously, travel operations of that business changed dramatically at the time. They have rebounded, but they're still not back to the earlier levels. The stock is up. It's a wonderful company. Among the attributes that I would suggest at Marriott is go to YouTube and find Arne Sorensen's message to the people of Marriott in the early days of the pandemic. And Arne Sorensen ended up dying from pancreatic cancer shortly thereafter, but it's a marvelous example of leadership and humanity. So we have great respect for the company. You can see we're customers of Marriott. In terms of the question somebody asked me earlier about CarMax, would you reinvest? Perhaps so. It was painful to sell it, but those were the overall conditions we were dealing with back in March of 2020. So we keep moving forward. Thank you.
Good morning, Mr. Gaynor and Mr. Witt, and thank you for the opportunity to ask a question here. I am Abhay Srivastav, and I am from San Francisco Bay Area. I just want to also thank you for all the insights that you have given over the years, and thank you for intelligently taking advantage of the float over the years and taking the full benefit of operating and financial leverage that is part of the insurance business, which is not easy to do, and only few companies have done so far. I have two questions for you and maybe for the team, and it's just my lack of knowledge, and I ask these questions, mostly trying to understand the operations of the business. My first question is, around the 10-5-1 plan that you introduced last year. When I first read it, my hands started shaking, given the nature of the commodity nature of the insurance industry. So, and given it's so easy to gain the insurance premium. So my first question to you is that, what are the top 1 or 2 things that you do when you're underwriting the policy that you're making sure that you're going to go earn 10% operating margin on that? That's one. My second question might span across all the 3 engines of the Markel, and which is about judging people. You invest in public companies. Somebody commented you have more than 50 stocks. So you are judging management of those people. You have done it for 32 years, as you quoted. When you're buying the Markel Ventures, you are judging the management all the time, right? And in my experience so far, judging people is the hardest thing to do versus the accounting and the business model judgment. So again, what are the top 2 things that you do in judging the people? Thank you for your time.
Thank you. Let me start off, Richie, you can talk 10-5-1.
Sure. 10-5-1 is something we came up with, I guess it was almost 2 years ago now. And it was really to have a stretch goal for our insurance operations. And our insurance operations is part of the insurance engine. That is the largest part of the platform. Very simply, we wanted to try to get to $10 billion in premium over the next 5 years, and the 1 is the financial result part of that, with $1 billion of underwriting profit. So first thing I guess I would tell you is no one is going to be fired at Markel if we don't get to $10 billion. It's an aspirational goal, and we've talked to the people about it's more about the journey than the destination. We think we can get to 10 billion, and we'd like to, but if we got to 9 billion or 9.5 billion and we had the kind of profitability that we want, that's a win, and we would all be excited. I guess the other thing I would say is there's no direct compensation linked to 10-5-1. Compensation for our folks in the insurance operations are all about the bottom line, underwriting profitability. Obviously, the more we can write at profitable, that increases the bonus pools, but nobody is going to be going out there trying to write business not worried about what the profitability component would be, because that just is not the way, 1, how our mentality works, or 2, how any of our incentive programs work. So we recognize it for what it is. We wanted to have a stretch goal for ourselves. We're going to do our darndest to hit it, but hit it in the right way where we bring that profitability to the bottom line when we hit it.
Yeah, I fully recognize that we announced that. Some people appropriately freaked out. Because in the insurance business, if we wanted to grow, that's easy. And Rich and I have been around long enough, and we've been through acquisitions, and we've looked at a bunch of insurance companies where, somebody would say, make all these promises about how much they were going to grow. And we both walked out of there and said, we're not touching that. So insurance is easy to write because the losses don't come until later. So if you only had a volume goal, A, you could hit it, B, you're likely to ruin the company. We know that. So that is why the 90 combined ratio, the 10% profitability, along with each and every dollar of premium volume that comes in, and all of the disciplines that have worked at Markel for over 90 years of financial integrity and making sure your reserves are more likely to be redundant than deficient. And the track record we have year after year after year after year of living up to that standard which we set for ourselves, that is all very much still in place and intact and growing, and will always be the case in Markel. So understand the concern about volume, but if I were in your shoes, I wouldn't worry about that. Second question about judging people and how hard that is. Actually, judging people is the easiest thing in the world. Now, judging people and being right about it, that's a little harder. Where does that come from? It comes from a couple things. One, it comes from curiosity, caring. So I would suggest there are a lot of financial transactions that take place between people who don't know one another. And it's the transaction, it's the numbers, it's the spreadsheet. It's, things that are anonymous. Well, we don't do that. So if we're going to enter a transaction with somebody, we're going to know them. We care. We want that to be not a one-off. We want that to be something that recurs over and over and over again. So we got to get to know them. We got to have lunch with them. We got to have dinner with them. We got to walk with them. We got to go to a ball game with them. We got to walk through their places of business with them. These are things that underwriters do in their relationships with people. If they're going to underwrite a particular business, they will spend time in that business to have some sensation of the risk that comes from the intangible touch and feel and curiosity of being with people. Very important. So that's important. One financial metric, and I think Shelby Davis has left. I don't know if he's still here or not. But when we were first starting down the path of buying Markel Ventures companies, a lot of people said, you don't know what you're doing. You're gonna make epic mistakes. And I was talking to Shelby about it because he's been a mentor of mine and a friend for a long, long time. And he's pretty quick with his words and can be blunt from time to time. He says, well, if you want to buy a business that's not run by crooks, buy one that doesn't use a lot of debt. He says, because if you're looking at somebody who owns this business and they're using equity capital and not debt, they're running that business with their own money. If they're using debt, they're using somebody else's money. And he says, look, a crook doesn't want to steal his own money. He wants to steal somebody else's money. So if you're looking at a business that is highly equity financed and uses very little debt, you're looking at honest people who are running that business because they haven't set up the temptation. They're not using other people's money to fund things.
Even after all that, you'd say, I think, and this goes to your point about being willing and being an organization that makes mistakes, as the saying goes, how do you know if you can trust someone? You trust them, and then you'll find out. So you can go through all the tests in the world you want, and I would agree with your implication that it's hard, but I think it's hard in a different way than you're suggesting. The reason it's hard is because sometimes when you trust someone, you shouldn't have, and then it's very, very, very painful. And having the willingness to stand back up and remember that on the opposite side of that, when you do trust someone and it works, there is no greater sensation that ever existed on this planet, and it's worth it.
Absolutely. And the word for, the word for trust being broken is betrayal, to give you some essence of the emotional pain that inflicts. And it happens. But unless you trust people and are willing to be betrayed, you'll never get to the other side. And you heard Buffett talk about it a lot yesterday, where he says, we run a business where we want to be trusted. And so that's us too. We run a business where we want to be trusted. I enjoy being trusted. My colleagues, this team, they like being trusted. And that is a powerful flywheel that once you get a system that's designed to do that, you get more and more stuff. These people selling us these businesses, they are handing us their baby. They've spent their lives building these businesses. They're trusting us. That's a heavy burden, but the more we honor that and do that well, the more babies that get handed to us who grow into productive members of the Markel family over time. And we do learn. So Mike is correct. He says the way you do that is you trust, and we trust. That's our default response. I believe you. This is going to be good. Let's go. And if somebody betrays that, well, I'm never doing business with them again. I'm not. So, we won't get it all right on the first hand, but we won't make recurring errors with the same person. Thank you.
Hello, my name is Hassan. I'm a 21-year-old college student from Toronto. I've been a shareholder for about 5 years. My question deals with the operational management of your privately owned companies. It's an important part of the value creation for the corporation. So I'm curious to hear your trade-offs on the different philosophies between a traditionally decentralized model of your portfolio companies versus maybe a large private equity firm that could have an operational support group that can deliver talent and resources to their portcos in addition to the capital for bolt-on M&A, growth CapEx, that sort of thing.
Right. Let me let Mike take the first pass at that since he's responsible for that.
Well, to be honest, I was trying to pass it back to you. This is my first time up here, and I just got a round of applause for my last answer, and I was sort of hoping
you
to
got
be
another
done
one just now. I think you figured it out.
There's only downside for me at this point, Tom. what we know is what we do, and that's not the only way to do it. We see marvelous examples of people who look for businesses that need that kind of help and who have developed an expertise in taking an okay business and making it a great business. And our hats are off to those folks in Markel Ventures. It's not what we do, but what we do is extremely rare, and it ties back to that trust conversation we just had. And it's, I think, why Mike would say he made his comments earlier. We want exceptional people that know what they're doing, and we want them to give the space to build like we love to build. And somebody asked the question earlier about talent and how do we go about finding talent, and that means different things at different layers of the organization. But when you talk about those key operators of the business who will ultimately determine our success and failure largely in this company, those are people who want to build. And if you're a true builder, you want a couple of things. You need time and space to build what you want to build, and you want to be left alone and not be told what to do by people who are far away from the action and don't know what to do. And that's what we've created, and for us it works, and for the right kind of business it works.
Indeed so, and yeah. Mike correctly said that in this stage of our history in Markel Ventures, we're not the people who say we know how to do it and come in. Now, the good news is that the operating businesses within Markel Ventures, they sometimes have operational expertise in their industry, and there are bolt-on opportunities and bolt-on acquisitions that they can do at that level that we would not do at the Markel corporate level, where sometimes they need to not just buy the business, but operate it with their management. So in the fullness of time, we'll do both, but that's done at the operating company level rather than the corporate level.
And you guys, just last thought on that, I mean, you all are here assessing competitive advantage with this company as in any other company, and it's a hard thing to get true, durable competitive advantage. And what you just spoke to is one way that continues to be distinct in the world. And we would talk about that in terms of the scale of the qualitative and the quantitative measures. So within ventures, not so true in the insurance engine, but within ventures today, I don't know what the number would be, but somebody walks in the door probably every 30 days and says, gosh, why don't you consolidate healthcare plans and save a little bit of money, or consolidate purchasing of certain materials, et cetera, et cetera. Well, we know for a fact that between now and the end of the year, without too much effort, we could consolidate all the healthcare plans of the ventures businesses, and let's say we could save several million dollars into perpetuity. Well, if you're quantitative in nature, boy, that is just so appealing. You can measure that, you can feel it, you can taste the dollars and put them in your pocket immediately. Well, what's the qualitative cost of going to an individual business and saying, we're going to take away some of your ability to make decisions appropriate for the industry you're within? Well, you can't measure that. There's no way to know that answer. And human nature is to take certainty over uncertainty in many cases. And our willingness to make a bet on uncertainty creates an advantage, I think, that's a little tough to replicate.
Thank you. I would agree. Thank you. Sir.
Hi. Thank you for your time today. My name is Tony. I'm a 20-year student coming from California. I'm a prospective shareholder. I guess what I'm looking to understand a bit more is, when looking at your past performance for the past 5 years, you've done a phenomenal job in growing the top line. But at the same time, when you look at the share price, you have underperformed the market. I was wondering, to what exactly do you attribute that to, as well as what do you think the market is not seeing?
Well, you're correct in that the last 5 years have been some of the most challenging in the history of the Markel Corporation. And let's be blunt and explicit about what's going on there. March of 2020, and the COVID took us by surprise. The decisions we made to do things like sell CarMax and Marriott could be accurately criticized as not being the best ones that could have been made. So the market has penalized us a bit for that. the losses of catastrophes that have been just part of the fundamental insurance business itself, the challenges of CATCo, and a deal that didn't work, and the cost of extracting ourselves from that. So I think that is really the specific set of circumstances that people would have the most degree of skepticism about Markel about. And it's funny because Richie referenced earlier Terra Nova, and in fact, he and I go back far enough in Markel to remember the Shand acquisition, which was the first of our favorite double the size of the company deals. And this gets to perhaps what the market doesn't understand about Markel today, right now. So when we did Shand, and any deal that we've ever done, and this is especially true on the insurance side, remember that statement that we made about we want our loss reserves to be more redundant than deficient? That has never changed. That has been consistent from the very beginning. When we buy a company, and this is on the insurance realm, on day one, almost by definition, the early periods of that are going to be tough because we're going to be sort of leaning into the reserving process to increase the reserving level, which causes the apparent expenses to go up, which causes the apparent profitability to go down. Now that's following the rules of GAAP accounting and truing up books in the way that we think makes sense. But what that creates is a time lag where there comes a period of time where, we're jumping in on something, there's a problem, we're fixing something, we're dealing with something, we're putting up charges for it, whatnot. But then we go, we don't like to be confident, but hey, we got this, and it's working. Well, at the instant that Richie or I would think that internally based on sort of our own fingers in the dough kind of stuff, until the time that is reflected in financial statements has a time lag, because it needs to go on for a long enough period of time that some of the actions we took to make the reserves conservative on day one, start to develop out over 3-5 year periods, such that the market sees the profitability that's underlying there. So this is not our first rodeo. We've been in several situations at Markel where we're always going to be pretty daggone conservative and thoughtful and just tough on the financial statement presentation, and the public perception can lag of what reality is, because it takes a while for accounting presentation to catch up with economic reality. And I think we're living through one of those periods right now, and the only solution to this, and I know it's frustrated some of my colleagues and Markel shareholders, is that the only solution to this is performance over a long enough and extended enough period of time. And if we build the underlying intrinsic value of the company, the market will figure it out. And we've seen that movie before, and we think we're in one of them now. And so the last thing I'll say to you, you said you were a 20-year-old college student as a prospective shareholder. College students must have more money in their pockets nowadays than they did when I was 20 years old. So good for you. You get it.
Thank you.
Hi, it's Haydar Acun. I'm a fund manager from Turkey. Turkey has a great, fantastic private and public companies with potential returns of 5 to 10 times over the next 5 to 10 years, especially after the elections next year with drastic implications for the country. My question is, how contrarian is Markel in his investment decisions?
So are we going to invest in Turkey? I don't understand the question, sorry.
Can you invest in such a country internationally?
Yes, and I don't know if we do insurance business in Turkey through Lloyd's.
Oh, we're bound to do some, absolutely.
Right.
We do it just about everywhere in the world.
As you would know, given the geopolitical realities, inflation, things of that market, it would be hard, and I suspect it's hard when you're operating in Turkey. It's harder when you're removed from it. So the degree of returns that we would require and expect as threshold returns would be higher, but we'd be open-minded.
Great,
thank you. Thank you.
Dave Gerhardt from Atlanta, Georgia. I know a significant or a decent amount of your ventures is funded by your regulatory assets via loans, I believe. So I'm just curious to, maybe you can give some color on your conversations with your regulators, how they feel about that, if it affects your capital ratios, and what other things you can do in the insurance side because of those investments.
Thank you. Factually, it's really not that much. And at the onset of Markel Ventures, one of the things we were trying to do, and I think in the fullness of time we will do, is that at the insurance company level, the regulators will be comfortable with the financial performance of how the Markel Ventures do, such that they would give us credit for that in a capitalized value sort of way. Now, I wrote about it in the annual report. They have not yet seen the light on their joy at doing so.
Will they ever?
Ever's a long time.
Over time.
Here's the good news. If we keep making money at it, it'll work. And we have the opportunity, because of the capital strength of the entire organization, to keep investing appropriately in ventures opportunities. So the most important thing to me is that we keep doing well at what we are doing, and the rest of the world, including regulators, will understand and endorse that over time. So not that worried. And because the uptake on regulators thinking this is a great idea has been slower than what I would have hoped, we have dialed back the use of insurance company capital to do that sort of thing, and are using more the returns of the capital at the holding company level and Markel Corporation.
Hi, how are you, Mr. Markel? Mr. Gaynor, sorry. I have a quick question.
I'm not Mr. Markel, but I pretend to be him sometimes.
That's a good one. But nowadays it seems inflation is a buzzword. So I have a question regarding it. By the way, I'm from Maryland and a small town, Sykesville. And we were here for Berkshire Hathaway and wanted to see you guys too, so we are here. So my question is Markel Corp solely owned businesses experiencing margin pressure due to inflation? Yes. And if so, I would say how long you are anticipating inflation to last?
All right, the question is, are Markel businesses experiencing cost pressures and margin pressures from the inflation? The answer is yes. Okay. How long it lasts, I don't, as Buffett says, I don't believe any forecast, including my own. I can tell you that, month by month, day by day, we have our figures on the pulse of what's going on, and inflation has not been solved yet. So we will continue to manage the businesses in recognition of the reality that inflation exists, and we'll do the best we can.
Thank you.
Last question from Zone 2.
Okay. Good morning, Tom. Thank you for hosting us this morning. I'm Mary Smith from New York and a prospective Markel investor. My question addresses how technologies such as artificial intelligence and autonomous driving will ultimately impact insurance premiums and liability, ultimately the insurance industry as a whole. Wondering, what your thoughts are and how you're anticipating that.
Thank you. Richie, take the first pass.
Obviously, we'll have a tremendous impact, and it already is, obviously. Progressive, I think, would be considered one of those that were leaders in terms of just harnessing the power of the data to really understand underwriting risk. There'll still be needs for insurance. I mean, you may not be insuring individual cars. You may be insuring systems and so forth if it goes to autonomous driving, which it will eventually. So that bottom line is, I think technology is going to play a bigger and bigger and bigger role in our industry as well as all industries. We are working hard in terms of artificial intelligence and data analytics in our business, in our specialty businesses. We've got a long ways to go. And people that we would sort of look up to in that space would be somebody like a Progressive, who I think were kind of at the forefront of it when it all came together.
And the good news is, I hope this would give you comfort. When Markel started, or before Richie and I got there, the cutting edge technology that they were using was telephones and typewriters. And somehow or another, as each new technological development and wave has come about, we're not the people who invented them, but we were fast followers and adapters. Because whatever is being used, don't stick your head in the sand and don't think it's not going to happen. It is going to happen. It will create massive changes, and just be dynamic and adapt, and don't be stubborn, and try to figure things out going forward. That'll continue to be true going forward. Yeah.
Okay, thank you.
Last couple.
Hi, good morning, and thank you so much for hosting this panel and brunch. You're very kind to share in the meal with all of us and your wisdom and knowledge. And from what little I know about Markel Corporation, you have a wonderful culture, and there's so many lessons about making little progress at a time that I've learned about you, Tom Gaynor, and I think that's wonderful and something that we can all apply in our lives. And my name is Michelle Markey, and I'm from New Jersey. And as a millennial, ambitious young person who wants to try to make an impact in the world, I'm kind of curious, what do you look for? I heard a little bit about your talent search of what kinds of things you look for, but what would you recommend to a young woman investor who's trying to get to know how to invest, and also career-wise, potentially might want to join a company like yours and find a way to contribute in a way that we can make a significant impact as the next generation. So I'd just love to hear your thoughts about what you would suggest to people who are millennial women like myself.
Well, given that you're a highly talented young person from New Jersey, when I found myself in that exact same situation, I moved to Virginia. But so you're welcome. We'd love to have you. I would invite you to send me a letter, and I'll be happy to, of what your interest is, and I'll pass it along within the company. But all of the things we've been talking about, studying, being curious, exposing yourself to people who have been around that know more, that you would just have curiosity about, and willingness to learn, and willingness to just do whatever needed to be done. There's one story, a former colleague of Richie and mine that worked for Markel, and this was his mother was a very senior executive in the insurance business, probably back in the 1950s or 60s. And that was cutting edge. That didn't happen very much at that point. So she was a leader and a pioneer in what she did. And she had two sons, and when they graduated from college, because she was well known enough in the insurance world, she was able to get them an interview and perhaps give them a little nudge up. And so one of her children was a very good athlete. And at that time, the company softball team was a big enough deal that the companies would think about how good an athlete they had that they were recruiting coming in. So given all of the combination of circumstances, this guy went to work for this company, and they put him on the company softball team. And he came home one day, and he gave his mother the news that he had quit. And she hit the ceiling and just couldn't believe that this advantage that he had been offered and that he's not taking advantage of it. And he did not have the same sort of career that his other brother went on to have. And when you ask the other brother sort of what, and she says, "Why did you quit?" And she says, "Well, they made me play right field." And that insulted his ego, because he was a big-time athlete, but he was brand new. And instead of putting him in as the starting pitcher, they say, "Hey, new guy, play right field for a little while and prove yourself and see before you take the mound or playing pitcher or shortstop or whatnot." So his brother went on to greater success. And if you ask him how he became successful, he will say, "I was willing to play right field."
Thank you very much.
Good luck. Thank you. Mr. Andrew Thomas from Jackson, Mississippi, please.
Thank you, Mr. Gaynor. I appreciate that. Good to see you again, sir.
Likewise.
I'm here to ask how you protect your decision-making process from narratives that seem to rise and become an accepted fact. Sometimes they fall away. I know your process of focusing on good businesses with good management at a good price seems to be a natural protection. But I have friends who work in businesses where there's a new chair, where there's a new compliance officer who's hoping to meet ESG standards, not to make a better product more effectively or at a better price for a customer, but to achieve a better multiple in their stock price that they wonder will be a permanent thing moving forward. How do you protect yourself from narratives that sometimes rise and dislocate prices, but make us want to make what ends up being perhaps a mistake a decade down the road?
Thank you. That's an excellent question, and it has a lot of layers to it. So a couple questions ago, there was somebody who I think was a 21-year-old from Charlottesville, Virginia. And the best way I think I can answer, so maybe they go to UVA. So I'll talk about Thomas Jefferson, who's the founder of UVA, and I'm a UVA guy. And what Thomas Jefferson said, in matters of principle, stand your ground. In matters of fashion, go with the tide. So you can think about things that come up. If they're really principles, you should stick to those. And the principles of Markel, we write about in the Markel style. That is the creedal statement of the values that underlie the Markel organization. And some of the things that you alluded to, I think are covered well by the Markel style in that we explicitly state we want to run a company where each individual can reach their highest potential. So those are principles. Now, any given thing that comes along on a day-to-day basis, sometimes those are a matter of fashion, and we need to appropriately stay with the fashion and stay current and update ourselves, almost like the technology discussion that came forward. But it is a core element of Markel that we are a principles-based company, and principles mean things that don't change. So we'll stick to it.
Thank you very much. I sort of feel like I'm at a Berkshire meeting in the late 60s.
Well,
just so you know.
From your mouth to God's ear. You had a hell of a run.
Yeah. Hope to do that for
Our
you.
last question of the day.
Hey, I'm Alex. I'm a 20-year-old college student from Toronto. And I guess one thing I'm wondering about is there's this idea coming up that I guess a lot of sponsors are bidding up multiples. And when you guys get asked about that, or when Mr. Buffett gets asked about that, I think a response you often get is, well, there's this subset of companies that want a long-term partner, and they'll approach you, and they're not looking to partner with maybe a private equity firm. But I guess my question is, as you guys continue to grow, can you rely on inbound deals like that and that small subsector of companies that wants a long-term partner, or do you have to start thinking about sourcing deals and maybe competing a bit more with Wall Street? And then what does that sourcing process start to look like as you grow?
Right. I think that this is an awfully big world. So frankly, it surprises me the number of things that exist. So as one tiny example, very early days of Markel Ventures, we bought a company called AMF Bakery Equipment, which is in Richmond, Virginia. It was the first ventures deal we did. And really that deal and the first couple afterwards, there would be local press coverage of that deal. Well, one time after this, the phone rang and there was this guy, and he had this business, and it was in this I don't want to reveal any identities or whatnot here. It was a very prosaic kind of business, and things you'd see on street corners and whatnot. And he called to see if we would have any interest in it. So we had a little bit of a conversation, and I said, so tell me a little bit about it. Well, it turns out, and this is 2005 or so, the guy was making $10 million a year. And I said, where's your office? He says, it's behind the Krispy Kreme donut shop over by that shopping center. And turns out it was. Now, I had been in Richmond for 25 years at that point in time. I'd never heard of this guy. And here he is, he has this business making $10 million a year on a nondescript office behind the Krispy Kreme. We continually are surprised by what comes into the phone call. In fact, I'll tell this story. So one day, and it goes back to the Cottrell deal. So the way the process works within Markel is that, for a non-insurance deal, normally I would be the one who'd be first aware of it, or Mike or Andrew, but through the venture side, we become aware of things. As a courtesy, as a practice, as a way of governing Markel, the first person I tell about that is Richie. He's my partner, he runs the insurance business, and he'll look at it. And similarly, if an insurance deal comes across his desk, it came up through the team or channels, but the first person he tells about it is me, because we need to talk about it and have general agreement before we can proceed going forward. So one day, I walked in with news about the Cottrell deal, and I can't even remember how that came about to begin with, but we saw it, and I told him about it and outlined it, and he said, man, someday you're going to run out of eclectic shit to buy. And I said, perhaps so, but not yet. So that has been our experience so far, that it surprises you, and the wonderful eclectic companies that we've collected continue to come in the door.
We'd have bought that business if it had come with the Krispy Kreme.
Yeah, we didn't buy that one. With that, we're going to close. I just want to thank you all for coming. It's great to be here. Great to see you.
Thank you.
Thank you.
Thank you, guys.